addressing some of the major fundamental properties of any monetary system that has to overcome limitations and constraints. So, beginning with bankers' acceptances, we're going to explore some of those fundamental properties, those constraints, to see where, quite organically, even naturally, almost expected, the Eurodollar, this modern monetary system, took the next leap into what we would recognize more today as a sophisticated, complex, almost unrecognizable, at least to the standard textbook approach, monetary system, which, by the way, just happens to be a global reserve currency. Again, that's one of the reasons why I like to start with bankers' acceptances, because acceptances from their very beginning are really about international trade, international flows, international money itself. So all the properties that we went over in our last video don't just apply to a domestic currency system, they apply especially to this global arrangement. So we're going from analog toward a more digital, more mature phase future. And we're going to start with a story about acceptances where they meet the circus. Because again, I love this image because it goes back to the early days of the Federal Reserve, even before the Federal Reserve, reminding us that there was a major task from the very beginning, the idea that we want to use a paper ledger money system, which is more efficient and effective for various reasons, to accomplish mostly international business. You take a piece of paper across the ocean, you don't need to bring with you a foreign source of currency. You want to trade with Japan, you don't need yen. You have a piece of paper from a bank in good standing in that system, which says you have the currency that's usable in these places, therefore you can buy and sell goods. But more than that, what the story about acceptances told us was that there was a lot of work involved here. It wasn't so simple as creating a piece of paper and transporting across the sea, right? Because in the earlier days, even the 1960s and 70s, let's be honest, those of us who were not quite old enough to remember those times, but were old enough to hear our parents talk about those times, they sound practically primitive to our internet age ears. What we saw, I mean, the idea of a rotary telephone, a telex, a fax machine, all those kinds of things that to me were wonderful inventions now seem incredibly archaic. But it wasn't just a method of communication. There's much more to it. And that's what I hope you took out of video number 16. That we're not just exchanging money across vast distances. In order to actually do that, it required a lot of time and effort. Because, in the days before the internet, you have this information blackout, this information blind spot. You want to buy goods from Japan. Do you really know who you're buying goods from? You want to sell goods from Japan in the United States. Who's on the other end of the transaction? There's a huge amount of risk otherwise that takes place across these distances, including the idea of whether or not there's any common currency in between. So there's a lot of work that has to go into even something as relatively simple as an acceptance. So an acceptance as an instrument is a little bit more complicated, but yet on the surface it is incredibly simple. But what goes into making that is not. So remember our basic setup here. We had a buyer who's trying to buy goods and import them into whatever country. It doesn't have to be the United States, because remember we had third country bankers acceptances, which meant that a bank, say in Europe, would be buying goods from or a company in Europe would transact through a bank in Europe to buy goods from Japan, and the Japanese seller of goods would translate through its own local bank. And as long as the bank in Japan could connect to the bank in Europe, usually through a third medium, which is our Eurodollar banks, then we had a level of assurance based on the amount of effort that goes into this process that payment will be made on time in a way that's predictable, transparent, and well known to all the parties involved. But that doesn't mean that there isn't risk here. Because again, you can never know for sure. You can never know exactly what's going on in each business. So as I teased in that previous video, and I think I teased it in the introduction here too, there was a story, and this was printed in, I believe, the Federal Reserve Bank of New York's 1981 review. A little bit of a footnote talking about acceptances. There was a story of a bank in New York who wrote an acceptance for a circus, a local circus. This must have been the 60s or 70s, whatever the case may be. The circus wanted to buy an elephant from overseas because unless you're buying a used elephant, you can't get one locally, at least not very likely. So they had arranged for an import bill, an import form of acceptance, and as part of the letter of credit that was extended to the foreign bank, I doubt it was Japanese, so here we'll just pretend it's overseas. As part of the letter of credit, the conditions contained within it, the bank that wrote the acceptance and then accepted the draft for payment said, well, we're not really sure what's going on here either. We don't really know everybody involved, so we want a little bit of a security. We want to guarantee payment on behalf of the circus, but we're going to accept as collateral the elephant that's being transported across the ocean. Because, the circus itself might be a little bit shaky because, let's face it, it's not the 19th century circuses. We're going out of style. Business practices, all sorts of risks in between. So in this case, the import bill was collateralized by a live elephant. And wouldn't you know it, the seller shipped that elephant across the sea, and I believe it arrived in Long Island, and by the time it showed up, the circus had indeed gone bankrupt, which is, I think, what the bank was fearing, but still extended the acceptance credit anyway. Obviously, if the circus has gone bankrupt, the circus is no longer going to make the payment that it's obligated to make to pay off the acceptance. But since this is an unconditional draft of payment, the bank in New York has the obligation to pay the elephant seller anyway, which of course they did. But after doing so, they exercised the rights contained within the letter of credit and, of course, seized the elephant, which meant that now as an owner of an elephant, they had to find a place to store it. So they arranged a warehouse accommodation somewhere, I believe it was Long Island. I probably should have looked this up to make sure, but I'm pretty sure it was in Long Island. And either way, one day, the elephant got spooked for whatever reason and tore down one of the support I-beams in the warehouse. And by the time the next morning, bankers showed up to the warehouse, the elephant had destroyed the warehouse as well as it's destroying its own self. So now the bank had in its possession, instead of a going concern of a circus promising to pay, it has the collateral in the form of a destroyed warehouse and a dead elephant. The point of this story is that even collateral in our analog version of the Eurodollar system isn't so secure. When we're talking about collateral, using real goods in an economy as collateral, what that meant was not all the collateral was liquid. It meant that you got something of value, but it wasn't necessarily assured that you could, if there was a bankruptcy, if there was an interruption in payment, that you could take that collateral and make yourself whole again. It was a very different time. So already that's a constraint which creates even more pressure, even more of a need to intermediate. Because in the event that your collateral ends up dead on the floor of a destroyed warehouse, you've thrown a lot more money down the drain than just maybe what you've lost in terms of this defaulted acceptance obligation. Having those constraints, though, what that meant was that participants in this acceptance market, and really, again, it's not just about acceptances, it's about global monetary trade and global monetary transactions on every level. Again, we said that dollar providing was about credit. It was about reputation about standing in the Eurodollar market and collateralized by these illiquid real economy goods, what that meant was you had to defend your reputation, which means you had to stand behind your acceptances no matter what, which, given the fact that the collateral could be problematic, assuming there was collateral anyway, because a lot of these acceptances are unsecured, you had to be highly specialized. You had to have people working in your bank when you're extending an acceptance, accepting a draft from a counterparty. You had to be relatively sure that the circus that you're obligating yourself to pay for that elephant coming across the ocean is going to be there when the elephant arrives. So you have to have somebody who knows that business or that industry or something like along those. Information is at a huge premium, as is expertise. So this is a highly specialized, highly labor-intensive process of global intermediation, which makes it even more complicated, right? Because not only do you have to know about circuses on this side of the ocean, you got to know about elephants that are coming from across the ocean and how they're going to get there and where they're going to end up. It's very, very labor-intensive. But we know that not just the acceptance market, but the entire trade and reserve currency market itself, again, I'm showing you this from where we left off in video 16, we know the acceptance market and the entire global currency market, the global Eurodollar system, even in its analog original phase, expanded rapidly throughout the 1970s in particular. The Great Inflation. Why was it a great inflation? Well, economists have no idea. They think it has to do with acceptances when we know better. It was these Eurodollar threads being stitched tighter and tighter together, as well as creating avenues to expand. But if the method of all of this Eurodollar business is really dependent upon highly specialized pockets, highly specialized people operating within financial constraints or operating in financial ways, then that limits the amount of volume growth that can be relatively cheaply and effectively and efficiently created, right? Because you only have so many people who are specialized in these various areas, and there's only so much you can train other people to come in and recognize. The amount of expertise is essentially a limiting constraint. So intermediation that is absolutely required to get these types of transactions done becomes itself a constraint, because at some point it becomes very cost ineffective for any financial firm to engage in that type of behavior without taking on a lot more risk than it is prepared. Maybe that example of the circus example, the bank in that example was trying to expand too quickly, and whoever accepted that draft on behalf of the circus, maybe they shouldn't have done that to begin with. Maybe there was too much pressure to get the job done for volume reasons. So because we have these limiting constraints, what it means is, in a word, scalability. That becomes a question. How do we get around this analog way of doing things that, if we're transacting in a paper world, which, by the late 70s, it's more electronic than not, but either way, there are all sorts of these means of exchange, actual means of exchange that create bottlenecks, limits to scalability. How can we mass produce what financial firms are doing? Now, we know what they did. As I said, they did it in the 1970s, but how did they get around these very fundamental problems? Because you need to have intermediation. Otherwise, you're just throwing darts, and you can't throw darts and continue to operate as global currency. As I said, reputation is everything. And without reputation, we don't have dollars. But how do we maintain our reputation? Intermediation. But how do we scale given maintaining reputation if intermediation becomes extremely inefficient beyond some level of volume? It seems like maybe an intractable problem at first. So what we have here, this intractable problem, we have intermediation. We have to have some way of understanding the goods marketplace. From the one side, you have to have dollar providers who understand the borrowers who they're accepting payment drafts on behalf of. Remember, that's what the banker's acceptance is. The buyer promises to pay at a later date, and the bank promises to stand by that payment obligation by writing a draft before the payment ever comes in. So you have to have expertise and knowledge of that part of the market. Of course, then you have to also have the same thing on the other side. Whether banks in the United States, outside the United States, foreign, local, whatever the case may be, they also have to have a tremendous amount of knowledge of those overseas parts of the marketplace, or the international parts of the marketplace, which, by the way, isn't just about the businesses operating in exports and imports. It also means legal problems. You have to have lawyers. You've got to know about the accounting conventions. You've got to know about regulations. As I said, this is really labor-intensive kind of stuff. Unless you're willing to be loosey-goosey, which you can't really afford to do since your reputation is everything here, again, it becomes very highly constrained. It becomes very highly labor-intensive, therefore cost ineffective beyond some point. And then we also have to remember, especially in the 1970s, the advent of the wholesale market. As I talked about in video number 16, bankers' acceptances that were discounted and then rediscounted were often rediscounted into the wholesale market, where the buyers of those rediscountings were money market funds. These non-banks that showed up seemingly out of nowhere in the 1970s that we talked about in another prior video for this very reason. So you have to have financial firms who are specialized enough to know the wholesale marketplace. In other words, back then it was you had a Rolodesk where you could call up the manager of whatever money market fund and say, I've got a rediscount opportunity for you. Do you want to buy it? So you also have to have specialization in this section of the marketplace too. So already I think you can start to see where we're going here. At least I hope so. Because at some point it might make sense, instead of having one firm specialize on import buyers or fund flows or whatever the case may be, and another firm specializing on banks, businesses overseas, and another one who has a Rolodex and a window into money market funds and cash providers. Wouldn't it be better if we had just one class of financial firm that could do all of these things, either in-house or through their own contacts? We would have a single group of institutions and really businesses and capacities, capabilities, which would understand all of these various parts to this international market. And again, it's not just about global trade and merchandise. There's also financial flows that have to be navigated too. What we used to call hot money or capital flows weren't really capital flows, as we know. They're just ledger transactions. And oh, by the way, wouldn't it be great if this class of financial institutions could also provide those types of services too? What I mean by that is clearing services, settlement services, essentially sitting in the middle of all of these things going on to have enough knowledge of these various pieces to put together a money market fund with a bank offering a rediscount, and offering the bank the rediscount that is doing the rediscount an opportunity for a funding need, someone in need of funding a merchandise transaction on the other side of the ocean. Wouldn't it be great if there was one firm that could do all of these things and put all of these things together to better, more efficiently manage this intermediation, and at the end of the day, keep track of all of it too? Now, you might remember this from the wholesale money series. What I'm talking about, of course, is the one thing that we've really been missing from our Eurodollar diagrams. The one thing that we've kind of been building toward all along. I've been hinting at it here and there, but now that we have all of the bit players sort of assembled on the map, we put all of our pawns and knights and whatever else, chess pieces, monetary chess pieces on the map, we can now get into the real royalty of the Eurodollar system, the real guts of the Eurodollar system. Of course, I'm talking about global money dealers. Those are the firms who could transact across oceans, who had the intermediation capabilities to put together money market funds with banks that need funding, rediscount opportunities. Also, what we're going to get into in our more digital age of the Eurodollar system, a way to get around this inefficiency in intermediation. And that way is what we talk about all the time nowadays. I don't want to give it away just yet, although you probably have been able to figure it out. The money dealers are everything. They're what ties everything together. And over future classroom videos, I'm going to start to diagram what I actually mean by that. What does that really mean to have dealers in the middle of all these different pieces moving around? And why are they there? They're there because they do things that the digital Eurodollar system really needs them to do. But before that, let's talk about this intermediation concept to begin with. Let me move my picture here because there's stuff over here that we want to see. So in a very simple monetary system, very simple banking system, money creation is exogenous. Money is either a commodity form that comes, like gold that comes up out of the ground and gets minted at whatever place government stamp goes on it. Banks are essentially warehouses of exogenous currency, which means that really what they're tasked with doing is intermediation. So they take in money and then lend it out based on their perception of credit quality as well as profit opportunity in the marketplace. And we want them to do that. But in this very primitive bank setup, the one that shows up in all of the textbooks all around the world, it is again cumbersome because you have one bank that has its own supply of cash that has to then decide on credit opportunities in its own local marketplace, which means there are all kinds of limits to this intermediation. No matter how specialized and no matter how good that firm might be, its reach is always limited. So again, we run into the scalability issue, which is in one sense where these interbank markets come in. And really that was kind of the point behind the wholesale money series, was to show that once we started connecting these individual islands of firms together, they could start operating as a system. Instead of separate institutions undertaking intermediation on their own, we instead have a network of institutions that begin to not just specialize, but increase their geographic as well as other forms of qualitative reaches. They could do more things across larger and larger boundaries, including international boundaries. In the Eurodollar, of course, now we have the ability to create money, which of course then ties together with intermediation, which meant that in terms of limiting factor, in terms of what we're really talking about here today, money creation means an intermediation. What we're really talking about is the ability to most efficiently match the demand for currency with the supply of it. Now, when there's an exogenous currency system, whether it's government paper or commodity money, that's already an exogenous constraint. And one of the reasons why the Eurodollar system arose in the first place, as we know, Triffin's paradox or Triffin's dilemma, that was too much of a constraint. So the Eurodollar solved that and then some by essentially by marrying together the money creation function with the intermediation function. But in order to do that, again, thinking about bankers' acceptances, we have to have some way to get around these limiting factors of scalability, intermediation on a wide scale, which is difficult to do given the constraints here, because again, you have to have a lot of specialized knowledge. So how do dealers who become more and more central to even the analog Eurodollar system, how do dealers moving into a digital frontier, And again, I'm using these terms loosely and as more as illustrated purposes than to be taken literally, to sort of illustrate the evolution in the monetary system from more, I don't want to say primitive, but yet primitive to the mature stages of Eurodollars. They had to overcome these problems. And these problems were, again, related to scalability. How do we do this? We can't just have acceptances throwing around the plate around the world, because the demand for money is rising as the world becomes more and more interconnected. That means we need as much much reserve or vehicle currency as we can make available in order to supply the world with enough monetary resources to do all of these good things. Remember, there was a lot of good things about the Eurodollar system. How many countries around the world were lifted up out of poverty because of all the positive fruits to the way these things were done? So obviously the dealers did solve those constraints, but it wasn't in the way that we would recognize through bankers' acceptances. Obviously, the acceptance market, or maybe it's not obvious, the acceptance market sort of died out for these reasons. It was too much of a limiting factor for the system to continue to grow in the way that it needed to. And if you think back to, remember video number 2, when we talked about securities lending, acceptances like, say, something like federal funds, these were highly intermediation intensive forms of unsecured lending. Again, not all acceptances were collateralized. In fact, a lot of them were not, especially when they were done among closer counterparties. But again, as the point I'm trying to make in this video, in this classroom series, is that again, in order to do unsecured transactions like that, or transactions that are secured with real goods and real economy stuff, it requires too much effort. It's too expensive, too much intermediation. So in order for us to be able to get around that volume problem, we have to introduce a different form of collateralization. So instead of a system that runs largely on unsecured transactions, where we have to have individual parts of the system highly specialized in their own small arena, we now have these centralized dealers who have the ability to do something else. In other words, we're going to substitute collateral for unsecured, but the collateral we're substituting is not going to be real economy stuff and dead elephants. We can't have that. What we need instead is something that is standardized, something that is highly liquid, something that is fungible, some form of collateral that can be used widely, that doesn't require us to know a whole lot about everything on the other side of the trade. If I'm lending money and I'm getting back an elephant as collateral, I got to know something about the circus, I got to know something about the elephant, I got to know something about the seller, I got to know something about international law and trade. However, if instead I make an obligation and I'm using the collateral of something like a U.S. Treasury, the requirement for intermediation becomes much, much less. And in fact, it becomes much, much easier to grow. So as we have all of these Eurodollar fabrics, the Eurodollar threads begin to come together under the Eurodollar umbrella in the 60s and into the 1970s in particular, among them we have this thing called repo. And repo wasn't just a funny way for corporations to make money outside of Regulation Q, a higher interest rate. It became a mode of transaction for not just corporations, but also the financial firms, the dealers, to be able to lower their threshold of intermediation across a much wider expanse of the Eurodollar system. So by the time we get to 1981, we're entering the age of repo. We're entering the age of repo, but we still need to overcome some hurdles for repo to really take over and replicate, or at least replace, all of those functions of intermediation that went before. That's what we're going to get into in our next member video, number 18. How did repo really do that? Because when you sit and look at the Eurodollar fabric, and what we're really working toward here is essentially we've got all of these players involved. Remember, we've got ABS, we've got MBS, we've got bankers' acceptances that start to go away, but we also have money market funds, and sitting at the center of all of those are these dealers who are looking to essentially mass produce money. The globalization trend that began really back at the end of World War II, that gave rise to the Eurodollar system to begin with, was essentially begging for a way to mass produce money, and do so outside of the confines of Bretton Woods, do so outside of the confines, remember our review at the beginning of all these classroom videos, outside the confines of physical currency. And also, in order to get into that mass produced behavior, we would have to substitute collateral for intermediation, and highly labor intensive intermediation. In fact, intermediation didn't go away, but it was changed in a way that was very favorable to not just mass produced money, but to those dealers at the center of the system that were able to do the mass producing. So summing up our video here, wrapping everything up today, what we have is, again, I hope you took away from the banker's acceptance example how the, again, quote unquote, analog business became constrained. It's very difficult to mass produce money when you have to know everything about all the elephants that are being transported around the world, as well as all the circuses that are engaged in these elephant transactions to begin with. If instead we can collateralize much of our financial obligations through a common mode of collateral, almost a separate form of currency within that currency system, it would remove that limitation, allowing us to do a lot more with a lot less. And given the way that treasuries are structured in the monetary system, in the financial markets, we can also do this with what appears to be a more limited amount of risk. If that bank which had accepted the circus elephant as collateral had instead accepted a U.S. Treasury as collateral, there wouldn't have been any loss whatsoever. They could easily sell the U.S. Treasury instrument and be made whole, which makes everything more easy. It makes everything easier, including reduces the cost of intermediation, which gets passed along to customers, as well as rising profits in the monetary system itself. That's what mass production does in any real economy good, and that's what mass production did for a while in the monetary system. But as I said, getting into classroom video number 18 and forward, there's a couple things that we have to overcome before we can get into truly mass production of this Eurodollar money. So that's what we'll talk about next. Until then, thank you very much for joining me. As always, I hope you got a lot out of this episode, as you do any of the Eurodollar University offerings. And then next time, more repo. We're finally getting into the real nitty-gritty details. So I'm excited about that, and I'll see you again in the near future.